Hi everyone, I'm Annie Lee.
And I'm Jason Lin.
Today we're presenting SAP, a German multinational software company that provides ERP, cloud, and analytics solutions to businesses around the world.
After conducting our fundamental and strategic analysis, we are issuing a buy recommendation with a 2-year price target of $341 per share, compared to the current price of $204.
We'll walk through SAP's business model, competitive positioning, growth drivers, financial outlook, valuation, and risks to explain our reasoning. First, for a company overview. SAP is headquartered in Waldorf, Germany, and is one of the world's leading enterprise software companies. Its main product is ERP, Enterprise Resource Planning Software, which integrates finance, supply chain, HR, procurement, and compliance into one infrastructure. For large corporations, SAP isn't an optional software. It's the backbone of daily operations. SAP operates in over 180 countries, which gives it geographic diversification and stability. Lastly, the majority of SAP shares are held by institutional investors, by firms such as BlackRock and Vanguard, which reflects sustained long-term investor confidence.
Our investment thesis is built on three main ideas. First, strong customer dependency. As customers add more SAP modules, like analytics or compliance tools, they become even more embedded in the system. Second, high switching costs. ERP systems take years to implement and customize. Replacing SAP would be expensive and disruptive. Third, recurring revenue. Most enterprise contracts are multi-year, which creates predictable cash flow and earning stability. Together, these factors create long-term durability.
Now for a competition overview. SAP competes with Oracle, Microsoft, and Salesforce, and among others. Microsoft is strong in cloud infrastructure, while Salesforce dominates CRM. Oracle competes more directly in enterprise software. What differentiates SAP is its full ERP integration across core business functions. Compared to some peers, SAP trades at more moderate valuation levels and maintaining strong financial backing. Most importantly, SAP functions as enterprise infrastructure, not just another software tool.
Here we have a SWOT diagram showcasing the strengths, weaknesses, opportunities, and threats SAP faces. SAP's biggest advantage is how deeply embedded it is. Its ERP systems manage finance, supply chains, HR, and compliance, all core operations. Switching away from SAP would require retraining employees, redesigning systems, and taking on major operational risks. As customers add more features and cloud modules, SAP becomes even more essential. This drives strong retention, contract renewals, and recurring revenue.
Some are of our revenue drivers. So the biggest growth driver for SAP or SAP is its transition to cloud subscriptions. Instead of one-time license sales, SAP now generates recurring subscription revenue, and this improves predictability and earnings quality. Growth also comes from expanding within existing customers. Companies often start with core ERP and then add analytics, industry tools, and AI-powered features. And artificial intelligence is a key part of this expansion. AI improves forecasting, automates processes, and increases efficiency, which increases the value that SAP provides.
On a financial standpoint, SAP is stable and resilient, has a strong balance sheet and consistent revenue growth, especially in its cloud segments. While cloud investments may impact margins short term, they support long-term profitability. As subscription revenue grows, operating leverage improves. Overall, SAP shows financial durability rather than volatility.
Here are our forecasted earnings. So, looking ahead, we expect earnings growth driven by continued cloud adoption, AI monetization, and operating leverage as infrastructure costs are spread across more subscribers. ERP systems remain mission critical even in slower economies, and recurring revenue improves earnings predictability. In our view, the market is not fully pricing in this forward growth. So, in this graph, we have shown that we expect the average revenue to grow at around 11%, as the company has delivered a revenue of around 8% over 4 years from 2022 to 2025.
To determine our price target, we conducted a sum of the parts valuation. We valued SAP's cloud segment separately from its legacy software business. Because cloud revenue is reoccurring and higher growth, it deserves higher valuation multiples. Based on this analysis, we arrive at a 2-year price target of $341 per share. This represents meaningful upside from the current price.
So, our investment risks. Key risks include competition from large technology firms, AI displacement risk, and also execution risk with cloud migration and potential economic slowdowns reducing IT spending. However, SAP's recurring revenue model and global diversification help to reduce downside risk. Overall, we believe the upsides outweigh these risks.
So moving on to ESG consideration, SAP performs strongly in ESG. ESG plays an important role in SAP's long-term investment profile. Environmentally, SAP has committed to reducing its own carbon footprint and, more importantly, integrates sustainability tracking directly into its software. This allows clients to monitor emissions, manage supply chain compliance, and meet regulatory standards, creating both impact and revenue opportunities. Socially, SAP emphasizes workforce development and responsible AI governance, helping reduce reputational and operational risks such as technology adoption increases. From a governance perspective, SAP maintains strong transparency and compliance standards, which supports investor confidence. Overall, ESG strengthens SAP's competitive position, reduces long-term risks, and reinforces shareholder value.
Moving on to the topic of AI or artificial intelligence. AI is one of SAP's most important long-term growth drivers. So instead of selling AI separately, SAP embeds it into its core systems. AI improves supply forecasting, financial automation, and procurement optimization. This increases efficiency for customers and expands revenue opportunities for SAP. Because SAP already manages structured enterprise data, it has a strong foundation for AI development. AI strengthens both growth potential and competitive advantage.
So, in conclusion, SAP combines high switching costs, recurring revenue growth, cloud expansion, and AI interrogation. We believe the market underestimates the earnings potential of this transformation. Therefore, we reiterate our buy recommendation with a 2-year price target of $341 per share. Thank you. We welcome your questions.
And here we have our appendix slide. Thank you all again for listening to our presentation.